Welcome back to Wall Street Confidential. We are discussing the relevance or irrelevance of oil inventory numbers. Now, a lot of people are pinning their stock strategy to this and their trading strategy.
You know, I think that what you want to do, let's use some empirical evidence, which is always lost on the day-to-day because these numbers are so much fun to trade, like same-store sales numbers. These are data points that hedge funds trade. Inventories have been actually plus or minus for a long time. Right? But what's happened? Oil's doubled. So then you have to say, is there a correlation between the American inventory number and the price of oil? Now, if inventories have been steady, but the price has doubled, what I tend to say is, well, you know what? This is no longer either correlative or predictive. If it's no longer correlative or predictive and the stocks get hammered when inventories seem to balloon, then you have to say, if you have a longer-term view of the price of oil or natural gas, that you must use the steep declines in the stocks to buy. Now, there's another whole school here, which just says, well, we're beginning to see driving be cut down. Apparently, it's 4% year over year, and so therefore, you want to predict that oil will come down. My problem with that is, again, if driving is down 4%, why haven't the inventories gotten so out of control that there's no room to put the stuff? So what I'm trying to do is take I'm often criticized for taking a short-term view. I'm saying those who are taking short-term views are not making money for people. Decide whether you think that oil's going to 150 or 100. If you think it's going to 150, when it gets hit on inventories, then you buy. If you think it's going to 100, then you should sell, but develop a worldview of where you think oil's going. I think oil's fairly valued between 130 and 150. Historically, natural gas is you divide that price by 6, and whatever you get should be where the fair value is, the switching value. Until it gets up to 20, then you do not switch. You keep using natural gas or you switch out of oil. So both situations are controlled not by American inventories, but by worldwide demand, which creates the opportunity in the stocks.
One last question, Jim, because it's roiling the markets today. OPEC's president saying that oil could go past $150 per barrel. What do you make of that?
Well, again, the OPEC has been disingenuous the whole way. They've been saying it's controlled by speculators. Saudi Arabia is saying it's controlled by speculators and by commodity funds that are buying. Obviously, the Saudi Arabians have had a long history, as long as 30 years, of trying to keep oil down to make it so that we did not develop alternatives. All right. So suddenly they've changed their strategy and they want us to develop alternatives? No, they can't pump enough. So again, I don't trust the Saudis. There's a lot of people I don't trust in this debate. Because what I do, remember, I think, again, what's my approach? It's to look at what Transocean's saying, Diamond Offshore is saying. It's to look what Conoco, very honest company, is saying, what XTO is saying, what Chesapeake is saying. And those people are saying, listen, we can't meet demand. So their boots are on the ground. They're not theoretical. That's who I trust.
All right. Thanks very much, Jim Cramer, on who to trust and what to believe in this oil market. This is Wall Street Confidential. Stay tuned.